You know that feeling when you log into your brokerage app and you're just like staring at a wall of alphabet soup?
Oh yeah, tickers flashing green and red everywhere.
Exactly. Percentages are moving up and down, and there's this tiny voice in the back of your head that just whispers, do I actually understand the mechanics of what I'm holding right now?
I mean, it happens to seasoned investors all the time. People will allocate just massive portions of their portfolio into a three-letter symbol.
Right. Mostly based on, historical momentum or whatever they saw in the news.
Yeah, but there is often this distinct disconnect between that ticker on the screen and the actual structural realities of the underlying asset.
Exactly. And, you want to cut through the noise. You want to get to the core of what you are actually investing in.
You don't just want the surface level summary.
No, not at all. You want to know what is happening under the hood, how the engine works, and frankly, what the actual risks are. And that is exactly what we are doing for you today in this deep dive.
Yeah, we've got a highly detailed one-page financial snapshot today. It's a complete analysis dashboard of the Invesco QQQ Trust.
Which, most people probably just know by its ticker, QQQ.
Right.
And the dashboard we're looking at is incredibly comprehensive. We have everything from price and performance metrics to sector exposure and some really revealing risk metrics. Okay, let's unpack this. Because before we can even begin to dissect how the QQQ generates its returns, we really have to look at the sheer physical mass of this fund in the market.
Yeah, the scale is definitely the first thing that anchors this entire analysis. So looking under the details section of our source, the AUM, the assets under management, sits at $255.4 billion.
$255.4 billion. I mean, when a single fund controls $250 billion, we aren't just talking about a large investment vehicle anymore.
No, not at all.
We're talking about a gravitational force in the market. It's like a massive ocean liner or a small country's GDP. When capital of that magnitude shifts, it literally alters the tides of the broader exchange.
Absolutely.
Yeah.
And as of this snapshot, the current price is sitting at $445.89.
Which is just hovering a hair below its all-time high of 452.1, right?
Exactly. It's sitting right near its peak, which indicates immense sustained momentum. But, the context that makes that current price and that massive AUM so fascinating is the inception date listed right below it.
March of 1999, which is just a wild timestamp to see on a fund that tracks the heavily tech-focused Nasdaq Q100 index.
I mean, literally months before the infamous dot-com bubble began to aggressively burst.
Right. So if this fund was born right on the precipice of one of the most catastrophic tech wipeouts in modern financial history, and it still managed to claw its way to a $250 billion valuation.
Yeah, pretty incredible.
It is. What does that resilience actually tell us? Like, how does a fund survive a systemic shock right at its inception and then thrive decades later?
Well, if we connect this to the bigger picture, you really have to look at the mechanics of index tracking. The QQQ is tethered to the Nasdaq Q100. It's not a static vault where some manager just locked away 100 tech stocks in 1999 and hoped for the best.
Right. They aren't just holding those same exact companies from back then.
Exactly. It is governed by a pretty ruthless set of mathematical rules. The index is market cap weighted, which basically acts as an evolutionary algorithm. It naturally harvests momentum.
Meaning it systematically purges the losers and reallocates the money to the winners.
Precisely. If a company loses its market dominance or goes bankrupt...
Which happened to, dozens of tech darlings in the early 2000s.
Oh, yeah, absolutely. So its market cap shrinks, and as it shrinks, its weight in the index drops until it eventually just falls out of the top 100 entirely.
And at that point, the fund just dumps it.
Right. It automatically liquidates that position and replaces it with the next rising innovator.
So the fund effectively has a built-in survival instinct. The QQQ that took the hit in the dot-com crash is structurally not the same portfolio of companies as the QQQ sitting at $445 today.
Not even close. It's a self-cleansing mechanism. That $255.4 billion AUM isn't the result of perfectly predicting the future back in 1999.
Right.
It's the result of a strict, unfeeling mathematical process that just let the winners run for 25 years while aggressively cutting the dead weight.
Which transitions perfectly into what this evolutionary process has ultimately created today.
Okay.
We know how it survived, but let's look at the current DNA of the portfolio. The dashboard breaks down exactly what is inside right now.
Yeah, let's look at the exact holdings. The data shows the fund currently holds 101 companies.
Right. And, to a casual observer, holding 101 individual stocks sounds like a highly diversified basket. But then you look at the concentration at the very top.
It's staggering.
It really is. The top 5 holdings are listed here. Microsoft is at 8.92%, Apple is at 8.51%, Nvidia holds 6.13%, Amazon is 5.02%, and Alphabet is 4.95%.
So just those 5 mega-cap companies alone constitute roughly 33.5% of the entire fund.
Over a third of $250 billion resting on just 5 tickers. And yet, the dashboard provides a specific metric for diversification and explicitly gives it a rating of medium. I really have to challenge that logic based on the sector breakdown.
How so?
Well, sure, it holds 101 companies, but the exposure is 59% strictly in tech. Then you have communication at 16%, consumer discretionary at 13%, industrials at 4%, and healthcare at a tiny 3%.
Right, the drop-off is huge.
Calling a fund with almost 60% tech exposure and a third of its weight in just 5 companies, medium diversification feels incredibly generous. It's like ordering a mixed fruit salad, and the bowl arrives literally 60% full of apples.
That's a great analogy, and what's fascinating here is how the rigid taxonomy of financial sectors actually masks a much deeper functional concentration than the one you just pointed out.
Wait, really? Because 59% tech already feels highly concentrated. How could it be deeper than that?
Look at how those specific top 5 companies are categorized by the Global Industry Classification Standard. Amazon sits at 5.02% of the fund, right?
Yeah.
Officially, it is classified under consumer discretionary because its core revenue historically comes from retail.
Oh, I see.
And Alphabet, the parent company of Google, makes up 4.95%. It's officially categorized under communication services because its primary revenue is advertising.
Okay, wow. I see exactly where you're going. So that 16% in communication and the 13% in consumer discretionary on the dashboard.
A massive chunk of those buckets is literally just Alphabet and Amazon.
Exactly.
To the market and to the functional reality of your portfolio, Amazon's AWS cloud infrastructure and Alphabet's search and AI algorithms trade exactly like tech.
Because they operate like tech.
Right. They are vulnerable to the exact same macroeconomic forces, supply chain shocks, and interest rate sensitivities as Microsoft and Apple.
Oh.
So while the official paperwork proudly states you only have 59% tech exposure, your real-world systemic risk to the technology ecosystem is vastly higher.
So going back to my analogy, your fruit salad is actually 80% apples, but the label just insists on calling Amazon a pear and Alphabet a grape.
That is exactly the dynamic. The labels mask the functional reality of the risk you are taking on.
That fundamentally changes how an investor should view this asset.
Definitely.
But, to be fair to the data, we can't ignore the bottom 96 companies entirely. The dashboard specifically highlights holding number 7, Apelli at 1.37%, and holding number 8, Finnar at 2.01%.
And it's easy to look at a 1.37% allocation and just dismiss it as a negligible rounding error compared to Microsoft's nearly 9%.
All right, it looks tiny on the page.
But you have to scale those small percentages back against that gravitational mass we discussed earlier.
You mean the 255.4 billion AUM?
Exactly. If you do the math, 1.37% of 255.4 billion means that Apelli, sitting quietly down at position number 7, still represents about $3.5 billion of real-world capital inside this fund.
That is a staggering amount of capital for what looks like a smaller position.
It really demonstrates the sheer baseline strength required just to exist in this index. Even the tail end of the portfolio commands market-moving capital.
Yeah.
But it also reinforces your point. The fund is overwhelmingly top-heavy.
It is. And because the portfolio is so fiercely concentrated in these massive high-growth giants, we have to look at how that specific concentration translates into actual returns. And, maybe more importantly, what it currently costs an investor to buy those returns.
The price of admission, basically.
Right. Here's what gets really interesting. Let's look at the performance and valuation sections.
The historical performance data here is undeniably aggressive.
Let's start with the short term. We have a 1-month return of plus 4.20%, a 3-month return of plus 9.11%, and year-to-date, it is sitting at a very healthy plus 12.77%.
Solid numbers.
But the long-term compounding is where the jaw just drops. The 1-year total return is plus 33.15%, the 3-year is plus 40.7%, and the 5-year total return is plus 115.60%.
I mean, you're looking at an asset that has mathematically more than doubled its investors' capital over a 5-year horizon.
The dashboard also notes the all-time low was $210.33, meaning the fund has seen a 112% increase just to reach its current levels.
It is an absolute growth engine.
It is. But here is where I have to play the skeptic for a minute.
Okay, let's hear it.
We have to look at the valuation metrics on the right side of the page. The PE trailing is 28.1. The price to book is 7.1, and the price to sales is 5.2. Plus, the dividend yield is practically microscopic at 0.62%, with a payout ratio of only 12.30%.
Yeah, those metrics are the quintessential footprint of a hypergrowth portfolio.
Let's unpack the mechanics of that, though. With a dividend yield of 0.62%, literally nobody is buying this for quarterly income.
No, definitely not.
They are buying purely for the capital appreciation. But a trailing PE of 28.1 means an investor is currently paying over $28 for every single dollar of earnings these companies generate. Why on earth would a rational investor pay that kind of extreme premium? Aren't they essentially buying a luxury sports car at the absolute top of the market, hoping someone else will pay an even higher premium later?
Well, you are highlighting the core philosophical divide between value and growth investing right there.
Okay.
Because a value investor looks at a PE of 28.1 and immediately walks away. They prefer to pay, say, 12 or 15 times earnings for a mature, slower-moving company.
Right.
But the growth investor looks at that exact same 28.1 PE and sees a time machine.
A time machine.
Yes. You aren't paying 28 times earnings because you are satisfied with today's revenue. You're paying that premium because you believe the earnings of Microsoft, NVIDIA, and Amazon are going to multiply exponentially over the next 3 to 5 years.
Oh, I see.
If NVIDIA's earnings double over the next few cycles, your effective PE on the capital you deployed today shrinks dramatically. You are paying a premium for the velocity of future growth.
Which totally explains the 12.30% payout ratio.
Exactly. The payout ratio is the percentage of earnings a company returns to shareholders as cash dividends. At 12.30%, these companies are holding on to nearly 88% of their profits.
Wow.
And if you are buying a growth engine, you want them to keep that cash.
Right, you don't want a 4% dividend.
Exactly. You want them taking those billions of dollars and aggressively reinvesting it into server farms, AI research, and acquisitions to fuel that exponential future growth you're paying the 28 PE for.
So the high valuation is simply the entry fee for the expected trajectory.
Perfectly said.
But, expecting massive historical returns and paying a steep premium to access them inherently introduces structural risk. You do not get a plus 115% 5-year return without enduring a highly volatile ride.
No, there's always a trade-off.
Right. And the source data quantifies exactly how bumpy that ride is in the final section, risk and metrics.
Yeah, the dashboard is completely transparent about the turbulence here. The volatility is explicitly classified as medium-high.
And the actual drawdown metrics prove it. The max drawdown over the 1-year period is listed at negative 12.5%.
That's a sharp drop.
It is. That means despite the massive 33% gain over the last year, there was a specific window where an investor had to sit on their hands and watch their portfolio bleed out 12.5% from its peak.
Yeah, you have to have the stomach for it.
Definitely. But the metric that really caught my eye is the correlation to the S&P 500.
Oh, yeah. It sits at 0.91.
Right. And a correlation of 1.0 would mean it moves in a perfect lockstep with the broader market. So at 0.91, this fund is heavily tethered to the movements of the S&P 500.
Almost identical.
Yeah, when the broader market rallies, QQQ rallies. When the market tanks, QQQ tanks. Now, the expense ratio here is wonderfully low at 0.20%, which is great, and Morningstar gives it a 4-star rating. But here's the critical question. If this ETF has a MEDO 0.91 correlation to the S&P 500, why should an investor choose to take on the medium-high volatility and stomach a terrifying negative 12.5% max drawdown? Like, why wouldn't they just buy a boring, highly diversified, lower volatility S&P 500 index fund and sleep peacefully?
Well, this raises an important question about how we measure the efficiency of the risk being taken, not just the magnitude of it.
Okay.
And the dashboard provides the exact metric to answer your question. The Sharpe ratio.
Let's dig into that. It's listed here as 1.45.
Right. So the Sharpe ratio measures risk-adjusted return. It essentially asks, for every unit of anxiety and volatility you endure, how much excess compensation are you receiving? A Sharpe ratio of 1.45 is historically very strong. It indicates that the fund isn't just swinging wildly. It's systematically rewarding the investor for enduring those swings.
So it isn't just about the fact that it drops 12.5%, it's about whether the mathematical recovery aggressively outpaces the drop.
Exactly. You brought up the 0.91 correlation. Yes, it moves with the S&P 500 because the biggest companies in QQQ are also the biggest drivers of the S&P.
Sure.
But the S&P 500 has an anchor of slower moving sectors. Utilities, real estate, mature consumer staples that dampen its volatility.
Oh, and QQQ strips out those anchors.
Exactly. That missing 0.09 in the correlation. That tiny gap is exactly where the alpha lives.
That is where the outperformance actually occurs.
Yes. You willingly take on the unanchored volatility the 12.5% drops because
Right.
that is the mechanical requirement to capture the hypergrowth of those concentrated top 5 tech companies.
Honestly.
The 0.91 correlation tells you the general direction the vehicle is traveling, but the Sharpe ratio of 1.45 tells you that historically the sheer speed of this specific vehicle has mathematically justified the lack of shock absorbers.
So what does this all mean? If we step back and synthesize everything we've pulled from this one-page analysis, we're looking at an asset that is far more complex than its ticker implies.
It's more complex.
The QQQ is a powerful, highly efficient vehicle with a low 0.20% expense ratio and a proven evolutionary algorithm that has delivered massive historical growth over 115% in just 5 years.
Which is phenomenal.
It is, but accessing that growth requires an investor to completely abandon the safety of broad diversification. You have to accept severe concentration in mega-cap tech, even if the labels try to hide it.
Yep, 80% apples.
Exactly. You have to be willing to pay a premium PE valuation based on future expectations, and you must possess the psychological fortitude to ride out steep double-digit drawdowns.
Yeah, it's a remarkable, transparent snapshot of modern growth investing. And I want to leave you with a final provocative thought to consider, building off the data we analyzed today.
Let's hear it.
We started by noting that QQQ was born in 1999, right before a historic tech bubble burst, and it survived by evolving.
Right, the self-cleansing mechanism.
Exactly. But looking at its top 5 holdings today, Microsoft, Apple, NVIDIA, Amazon, Alphabet, which make up a third of the fund, we have to ask a really difficult structural question. At what point does a diversified index of 100 top companies effectively become a concentrated bet on just a single macro theme, like artificial intelligence?
Oh, wow.
And if that single massive engine stalls, will the medium diversification of the remaining 96 companies be enough to keep the ship afloat?
That is a profound structural question to sit with the next time you open your portfolio and see that 3-letter ticker staring back at you. Thank you so much for joining us on this deep dive. We hope this analysis helped cut through the financial jargon and provided a much clearer view of the mechanics driving your capital. Keep questioning the fundamental data behind your holdings, and we will see you on the next deep dive.